All right, let's talk about your crypto portfolio. If you've ever opened it up and just seen, well, a random jumble of coins you heard about on Twitter or YouTube, you are definitely in the right place. Today, we're going to ditch the guesswork, and we're going to build a professional, structured investment strategy right from the ground up. Yeah, let's be honest, this one probably hits a little too close to home for a lot of us, right? You bought some Bitcoin, then some Ethereum, and then, maybe a dozen altcoins that were pumping at the time. Look, it's a super common story, but it's not a real strategy for long-term success. So I want you to really ask yourself this question. Is there an actual blueprint behind what you own and why you own it? Or did it kind of just happen? If you're ready to trade in that chaos for some clarity, then this is absolutely the explainer for you. Okay, first things first. We have to make a big mindset shift here. We're moving from being a speculator to being an investor. And that all starts by understanding what it really means to build a portfolio with intention. See, portfolio construction isn't about trying to pick the next 100x winner. It's about building a system, a structure, that can handle the wild, inevitable storms of the crypto market. It's really the difference between surviving a crash and letting a crash completely magnify your risk. This is your game plan to stay rational when the market goes completely crazy.
So, how do the pros actually do it? Well, they use a time-tested framework that gives them both stability and, at the same time, the potential for that explosive growth we're all looking for. Let's break down what's called the core satellite approach.
The concept here is actually beautiful in its simplicity. You build a really strong foundation. That's your core, with the most established, most reliable assets. Then you surround that core with smaller, very carefully chosen, higher-risk investments. Those are your satellites. This entire structure is designed to give you resilience. This visualizes the balance just perfectly. Your core, which for us in crypto is going to be primarily Bitcoin and Ethereum, should make up the vast majority of your holdings. Think of this as your portfolio's bedrock, designed to weather pretty much any storm the market can throw at it. So the typical breakdown gives about 60 to 80% to your core, and the rest goes to your satellite altcoins. Now, if you're a more conservative investor, you might lean towards that 80% core. If you're a bit more aggressive, maybe you'll go down to 60%. The key thing to remember is that your foundation always remains the biggest part of your portfolio. But here's the thing, satellites isn't just one big, messy bucket of altcoins. To really manage our risk properly, we need to break that satellite portion down into a few distinct tiers. This hierarchy breaks it all down beautifully. Tier 1 is your core, Bitcoin and Ethereum, no surprise there. Tiers 2, 3, and 4, those are your satellites, and we're breaking them down by risk. So Tier 2 holds your more established projects. Think things like Solana. Tier 3 is for those emerging, less proven projects. And Tier 4, that's your pure speculation bucket, your meme coins. This is the money you have to be 100% okay with losing. Okay, so having the right framework is half the battle. But the other half, and honestly where most investors really get it wrong, is in the execution. So let's talk about the rules that make this whole thing actually work. I really need you to pay attention here, because this is where most investors fail. It's called position sizing, just deciding how much of your money to risk on any single investment. It is so critical. If you get this wrong, one oversized bad bet can completely wipe out all your other gains.
So the single most crucial rule is this: never, ever put more than 5% of your total portfolio into any single altcoin. I don't care how much you love the project. A 50% crash in a 5% position is a survivable 2.5% hit to your whole portfolio. But a 50% crash in a 40% position, that's a catastrophe. This one rule protects you from yourself.
Let's look at 3 concrete examples here. See a pattern? Even the so-called aggressive portfolio keeps a solid 55% in the Tier 1 blue chips, Bitcoin and Ethereum. Risk is added really carefully at the margins, not by abandoning the core strategy. Just find the model here that feels like it best fits your own tolerance for risk. Here's another pro tip for you. Don't look at stablecoins as wasted potential or dead money. Think of them as your strategic cash reserve, your dry powder. They're what allow you to buy the dip when everyone else is panic selling. Or they let you take profits after a big run without having to sell your core positions. They're a tool, and a powerful one, for seizing opportunity.
And finally, your portfolio won't stay balanced on its own. It's just not how it works. As some of your assets do better than others, your allocations are going to drift.
Rebalancing is just the discipline of trimming your winners and adding to your underperformers to get back to your target percentages. It's brilliant because it automatically forces you to sell high and buy low, and it takes all the emotion out of the equation.
Okay, we've covered the theory, we've covered the framework, and we've covered the rules. Now, let's put it all together into a simple, actionable plan that you can start using literally today.
It all comes down to these 5 steps. First, be really honest with yourself about your risk tolerance. Then, choose your tier percentages and pick your assets. Next, and this is key, set a quarterly reminder to rebalance your portfolio. And finally, remember this is a living document. It's meant to evolve as you become a more experienced and smarter investor. And to wrap it up, here's a cheat sheet of what not to do. Don't over-diversify into so many coins you can't even track them. Never, ever abandon your blue chip foundation or give a meme coin the same weight as Bitcoin. And maybe most importantly, stick to your plan instead of emotionally chasing the latest pump you see online.
And that's really the ultimate takeaway here. This isn't about getting lucky on a moonshot. It's about creating a durable, intentional structure for your investments using that core satellite framework. It's about managing your risk so that you can stay in the game long enough to actually win. I really hope this gives you a clear blueprint for your crypto strategy. In our next explainer, we're taking it a step further. Now that you know what to buy, we're going to learn the language of the charts, covering the basics of technical analysis to help you better time your entries and exits. I'll see you then.